Good evening. I hope you're doing well. It's been 10 months since I last created video on YouTube, and these 10 months have been some of the most intense in my trading career, and they have had serious repercussions on my trading systems, my understanding of the market, general approach, security selection, P&L, time frames, and everything within the ecosystem. The reason for the increased intensity during this period has been this particular chart that is in front of us. So, the chart that I have in front of us is that of the Nifty Small Cap 250, which is what we would call as a broader index. A broader index is an index which will contain stocks from various sectors. So, a broader index will also represent the pharma sector, the auto sector, the banking sector, and of course a sectoral index will represent stocks exclusively from that sector. Since uh, I don't have a particular bias towards any index or a particular sector, and I take decisions based on the price patterns that are formed, I try to incorporate or include the broadest possible index in my watch list in order to gain a sense of comfort that I am selecting the best stocks within the parameters that I have defined for selection. So, even though the chart in front of us is that of the Nifty 250, it is not a chart that I specifically trade. In fact, the broadest index in our market is to check that you just have to go to this website nseindia.com, go to market data, select indices. When you I'll just click it. When you select indices, you will come to this page which has the index in its categories: the broad market index, the sectoral index, strategy indexes, thematic indexes, and so on. From this, like I mentioned, my focus has always been on the broad market index because I do not have a preference towards a particular sector or a particular cluster of stocks. And within this, we will see there is Nifty 50, Nifty 100, Next 50, 200, 500, the mid cap, the small cap. But when we scroll lower, we will see that there is a index called Nifty Total Market, which essentially is an aggregation of 750 odd Nifty stocks across the small, mid, and large cap segment. So the large cap would obviously represent uh, stocks which have a very high market capitalization from various sectors, and the small cap on the other side of the spectrum would do the same thing but include stocks of a much lower market cap. The total market, Nifty Total Market Index, will include all of them. To determine how many stocks are there, you could simply download the watch list, which is on the right side, or you could simply just count you could take a sum of the advances, decline, and unchanged, which will be 751 because the index would be included. So, coming to this, chart, uh, we first, in order to make sense of the technical aspect of the analysis, we first need to come to a consensus on a few broader terms. So, the first description that uh, we all should have an agreement on is the definition of what is an uptrend, right? So, if I were to ask you what is an uptrend, most people would say that a security that creates higher highs and higher lows is a security that is trading in an uptrend if they're looking at price. There are also certain systems which would say that securities in which the ADX or the DI indicator is ADX is above 25 and the positive DI is trading above the ADX, that particular system is uh, a bullish trending system, and if the negative DI is higher, it is a bearish trending system. But here our focus is mostly on just the price action, and we will discuss the indicator aspects which we can select from here much later. So, since the general description is that any security that creates a higher high and a higher bottom is in an uptrend. So if a security is creating a new life high, it is there is no ambiguity that that security is in an uptrend. So I will repeat. If a security creates a new all-time high, there should be no ambiguity that the security is in an uptrend. I hope that you, the viewer, and I have an agreement on this statement. If yes, then we can proceed. If no, then I would suggest you internalize because this is quite basic and you will learn things internalizing this information. If a security is in an uptrend, the question is what do we do then? So, if a security is in an uptrend, then we have to buy the dip. So, I will just add this in text here. Do not know. So, I'll just select the text. If a security creates a life high, it is in an uptrend. Alright, and we have no ambiguity about this, so I'll just unambiguous, if that's a word. I'm not sure if it's a word. So we don't have an ambiguity, we don't have any ambiguity about this, that the security is in an uptrend. And if the security is in an uptrend, we have to buy the dip. Right? I mean, this is something that we have to do. First determine if the security is in an uptrend or not, and if it is in an uptrend, we want to buy the dip. It's quite simple. So let's have a look at this particular chart, and we will see that the high here, which is not clearly mentioned because maybe this software included this particular security, started tracking this particular index in 2019 and does not have accurate high low open high low close values for time period before that, but it's quite consistent that the broader market in the small and mid cap had peaked in 2017, and we can see the low here. This is the COVID low, at which point the index was at sub 3000 levels, and from here obviously the index rallied upwards, and in the process of rallying upwards we saw it absolutely take out the previous high of 7200. What is important to note is that as we move, this is the monthly chart. I have selected the monthly chart because the objective is to create an assessment of the trend and then to stick with that assessment for as long as time as reasonably possible. If you create an assessment of the trend on, say, the hourly chart or the 4 hourly chart, you will have to change that assessment very frequently, and it becomes difficult to take decisions if you are looking towards a mid-term or a slightly moderate term kind of an investment. And why are we looking at a mid-term and a slightly moderate term kind of an assessment also, I will highlight in a bit. So you can see the zigzag lines that I have drawn here manually. The indication is that prior to this break of 7200, this stock, this security was creating lower top, lower lows, and it was bearish trending actually for the period 2017 to 2020, and the COVID just exaggerated this particular fall. So there was no justification to be invested in the small cap index prior to 2020, and after 2020, once there has been such a large fall, the general expectation is that securities could range, and at best they could come and test the previous high. But if they break the previous high, so we see that it did start moving upwards, and if we just see how thematic this is, right near the previous high we see a doji, which is obviously an indication that the market is undecided, and the month after that the doji high gets clipped, and the market begins to rally. Now, uh, at this point, once this high was taken out, or let's just say 7500 was decisively taken out, there is no ambiguity in our mind that this is an uptrend, because we discussed that earlier, that a security that creates a new life high is in a guaranteed uptrend, and we have a new life high here. So we know that this is an uptrend, and we also know that if a security is in an uptrend, we have to buy the dip. Now, the question obviously now becomes like, okay, we have to buy the dip, but how do we know where is the dip, and how do we determine which particular dip to buy? So, this will require us to come into an agreement with another concept, and that concept is that of Fibonacci retracements. So, the concept of Fibonacci retracement, I mean, I will not get into the details of the theory, but very simply put, I'll assume you know a few things. That if the pullback is, say, at 38% Fibonacci retracement, we will consider this very natural, and our default assumption will be that we want to buy. Default is to buy on any confirmation, yeah, or bottom retest. Like, if the pullback is still the 38 Fibonacci level, we have to consider this as natural. I mean, there should be no ambiguity that this is a natural kind of a pullback, and our default tendency should be to buy this. If the pullback is at 50 and it is taking support, we have to say that the security tends towards being a bullish strong security. Yeah, so a 50% pullback also we will assume it to be of high strength. If the pullback happens till 68%, then we will say this tends to be a bullish weak security. So if the pullback is 68%, the security is bullish weak. If the pullback is still 78%, we will say that this is a security which is ranging with a long bias. Yeah. And if the pullback is all the way to 100%, then it is a guaranteed range, and at which point you can take natural longs and shorts, and it is justified on the longer time frames. So here I have mentioned that a new life high equal to an uptrend is equal to a uptrend, and we have no ambiguity. In an uptrend, we will buy the dip. This is also no ambiguity. And now we're just determining where to buy the dip, and we assess that a pullback to 38 is natural, and our default is to buy on a confirmation or bottom retest. Um, and 50 tends to being bullish strong, 68 tends to being bullish weak, 78 is a range with a long bias, and 100 is a range. As a trader, as a money manager, as a person who intends on doing this business professionally, you are going to experience all of these pulls from 38 all the way to 100, and it will extend at beyond 100. It will go to say 128, at which point you have to get ready for harmonics. Like, usually harmonic patterns are playing out at this point. So as a trader, your job is obviously to create a framework for each of these pullbacks, and to determine how much are you going to invest, and what will you do basically in such a situation. And the advantage of trading in shorter time frames is that on the monthly time frame it becomes very difficult to experience this entire gamut of Fibonacci retracements if you're trading very few securities. But on the hourly or shorter time frames, futures traders have this edge that they would have experienced these combinations and a lot more, and their trading systems would necessarily be designed to cover these factors. So as you gain strength in your assessment of um, uh, not just technical analysis, that is, technical analysis is simply the understanding of these terms, but I would say planning through technical analysis, which is a combination of more than one thing, which I will also discuss later. So um, just a recap is, we now have understood that what we have to do on these pullbacks, and now the question is, where do we apply Fibonacci levels. So the answer is that we will always use the pivotal high and the pivotal low only, which means that the clusters that are formed in between, we will ignore them from the perspective of a long term trend. The clusters in between have to be traded in the direction of the preceding move. That's the rule, and if you want to check out on the statistical edge that you will have in following that rule, I can suggest you to go through this book, which is Encyclopedia of Chart Patterns by Thomas Bulkowski. I read this book, I think, in 2015, and I hope I've got this name right. It's a very Polish kind of a name, and it's it was useful at the time for me, because I was exposed to another kind of an approach, where to the market, where people viewed markets purely from a very statistical, numerical, um, in a very numerical manner, and the reasoning was that when the sample sizes are very large, then laws of large numbers get into play, and statistical events can be statistical results are become significantly more reliable if the sample size is very large. And in the markets where billions of contracts are traded uh, every month, or maybe even every day, the sample sizes are huge, and the the playing field of any statistician, or anyone who enjoys patterns, price patterns, to play. Anyways, so coming to the point that we would always use Fibonacci from pivotal highs and lows. So I will simply select the Fibonacci tool from here, click on the lowest point, drag it to the highest point, and just to see the relevance, just push it horizontally and stop somewhere here. All right, and now what I want you to see is where is this low, 76.15. Yeah. So obviously at this point, I mean, if I have this text at this point, I want to buy. Okay, but there is no pullback. There is obviously no pullback. At this point, I am seeing the pullback, and the pullback is to 38%. And we have discussed that a pullback till 38% is perfectly natural, and we want to buy on either the first confirmation, or we want to buy on a retest. So different traders can have different strategies. I am from the category who who would buy on a retest. On extremely long term time frames, I would buy on a retest. If the trade is a short term one, like a futures trade, I will just go in with the confirmation, simply because future trades have more parameters than simply higher highs and higher lows. Uh, this approach works when you want to form a general view for a very specific trade. You would definitely include more variables in order to skew the probability, in have micro edges in your favor. So regardless, we have seen that from the pivotal low to the pivotal high, the pull, so that is from 3000 levels to roughly 10,500 levels. When the index did come to the 7500 levels, it had completed a 38 percent Fibonacci pullback, and now, which is perfectly natural, and we are looking to buy. And now when you notice this particular candle, we must understand this is the monthly chart. In this candle, we will note that this candle, the body of the candle completely engulfs the previous candle, right? I mean, this candle which is formed on July 22, the green candle, is completely engulfing the candle formed on June 22. It's not the perfect bullish engulfing, but it is, on monthly charts, it's very difficult to get a bullish engulfing because the security has to gap down on the first of the month. But you can create a leeway that you know, you can't argue that it is a Marubozu also, because for that the open and the low needs to necessarily be same. So this is discretion. I mean, I'm sure I'll be violating a lot of system rules if I'm calling this bullish engulfing based on a coded system. But when I see this visually, to me on a and I know it that this is a monthly chart, then I will tend to call it a bullish engulfing, simply because of the rarity of getting a bullish confirmation on monthly time frames. So there is no ambiguity now that after having seen this bullish engulfing, I am willing now to bet that the lows of 7600 in the market will hold. And obviously, this bullish engulfing needs to be confirmed, and the confirmation came the month after that. And now from this point, basically all that I'm seeing is a structure that looks like this. I will just see if I can find um, an arrow. I just select this here, and then I will see if I can find some parallel channels, and I will select this here, and I will extend it, or at least it's supposed to extend from here. Now this one extended. Anyways, so the idea is that when I am seeing a strong uptrend with this kind of an incline and a doji at the high of this channel, there is no ambiguity that this is now forming what is looking like a bullish flag pattern, flag and pole, where we are seeing a move from nearly 3000 to 10,000, that is 7,000 points, and a break from 9500 should give it another 7,000 points target. So now this trade is looking ready to go for 16,000 on the index, 16,000 on the index, as per the bullish flag pattern. And I need to wait for confirmation. I mean, it's formed a doji at this level, as we can see. I mean, I'll try to extend it. It's formed a doji pretty much at the high of this channel, and I am looking at either a break of this doji, a sustained break of this doji, or a retest into the channel. But this low, the 7600 low, should not break, because if the 7600 low breaks, then the pattern becomes void. The pattern will become void because what we will have here is a higher top. Um then here obviously, after that higher top we would have a higher bottom, which is perfectly good. Then now, assuming this high here is now defended, so this becomes the lower top. And let's just, this does not actually happen, but let's just say the price was to, instead of only dipping till here, go all the way here for some reason. So say the price were to go here, then we know that this has become a lower top. I mean, once it breaks this place, it is now getting ready to form. At this point here, obviously it will become a double bottom, and when once it moves from double bottom and goes anywhere here, we are seeing a lower bottom, and this security then becomes a sell on rise. If so, therefore, I mean, if after the flag formation, if the low is taken out, then obviously the security has formed a lower top, lower bottom formation, and you will have to exit it. I mean, there's no way you can go long on it structurally. There could be individual securities that will always be bullish, but you are not going to see a whole market breadth, strong market breadth in such a scenario. So any which ways, we are here seeing the doji, and I'm seeing the doji high being tested at about 9800 levels. It doesn't sustain there, and then there is a close. And now with this dip on this low at sub 9000 levels, this security has come into the chart and into this particular this pattern. Like, I mean, if we just have to keep extending it. It has now started dipping into this particular channel, and this dip into the channel is now going to invite capital. All right, it is going to invite capital from me. I have to buy into this because I am looking at a potential move from 9500 to 16500, and I only need to, and at this point here already the market is at 8800. So from these levels at say 9000 levels to 7500 levels, I'm just risking 1500 points, and I am seeing a comfortable 7,500 point pattern target on this stock in the next 18 months. A 1 is to 5, a 5 is to 1 is to 5 risk reward is a no-brainer that you're going for this. And obviously it is important to note that I'm not taking position on this particular stock, Nifty 250. I'm only using Nifty 250 as the closest proxy to the Nifty total market index, and I am going to take individual level stock decisions much later. I'm just seeing if the broader index is it good for investing or not. And logically you will logically you will start seeing posts from me, even though I was inactive on YouTube. But you would have started seeing posts from me on various social media sites in and around Jan, Feb, March, that it has become time now to take a bet in the market and actually to increase equities. Because if the extremely broader market like the Nifty 250, which like I said is a proxy for Nifty 750, if the extremely broader market is forming a bullish flag pattern on one side, which means that there are 750 stocks which are getting ready in some way to break uh, either new highs or at least range highs. 750 stocks across the market are theoretically getting ready, uh, is going to invite serious amount of money into the equity market. On the other hand, we are seeing interest rates at almost 25-year highs, which means that bonds have become extremely economical to buy, and anyone who's looking to create a long-term debt portfolio, say someone like me who's in mid 30s approaching early 40s, the question to a person like me, the question that I would ask myself is, if the interest rate at 7.5%, if the government of India is issuing bonds at 7.5%, if I'm not willing to take on those bonds now, then when exactly am I going to create a bond portfolio? Which means that this point in the market, this particular point in the market, in which the this is around Jan, Feb, March this year, 23, when the market dipped into the channel, the flag channel range that we have just identified. Uh, Not only was the market inviting to buy in the stocks but also in the bond market. And now if the bond market looks like you're getting great value, in the stock market it looks like you're getting reasonable value, the question is, what do we do about the futures market? Because we understand that that in the futures market, the performance of the futures market is inversely proportional to the interest rate hikes. That's largely because futures traders are trading on borrowed capital, and if the interest rates are higher, they are paying more, and therefore, this scenario basically, it was a very difficult time for me, uh, let's say mentally, where I had to come to terms that maybe this is a scenario that instead of buying futures at so much premium and paying so much STT, perhaps it is easier and safer to take a bet that the small cap index, which is at about 9,000 levels at the time I was seeing it, is unlikely to break 7,500. And and obviously having a 1,500 point SL on a 9,000 point security is a 16% SL or a 17% stop loss at the index level, and a 17% stop loss on the index level will constitute to about 30 to 35% on an individual stock level. So I had to closely assess how much capital do I want to risk, because in case the market is to create a lower top, lower bottom, I would stand to lose. In theory, at least 35% of the capital that was deployed, because obviously here we are trading the monthly time frames, and the small caps and the lower cap in stocks are extremely volatile. And when they break, they don't just break, they create circuits, and they don't allow you to get out. So you have to assume the worst when you are planning from a risk management perspective. And I had to really come to terms that how much am I willing to lose. And somewhere along the lines I felt that okay, I can risk about 30-35 lakh rupees on taking a bet. And in order to risk that 30-35 lakh rupees, I went and added approximately 1 crore rupees into the market at this point, in order to buy equities. And so that the I added the 1 crore so that I can buy equities and my futures trading continues undisturbed. So breaking an FD when the interest rate is almost 7.1% for individuals like me, and getting it into the equity market, fully aware that you're risking about 17% at the index and 35% on a stock level, and breaking a family FD to fund a demat account, um, is yeah, is not the most difficult decision in the world, but compared to many other decisions, it's a reasonably challenging decision. That is a decision to break a family FD and just to allocate it to the market. So nonetheless, I did it. I added capital and I started buying stocks. And I have shared several tweets. I have shared it on LinkedIn. Um, I have wherever possible. I mean, whoever I spoke to, traders, investors, whenever we spoke, I said that there is a reasonable play in the market. And then after my entry, once the market gave a huge bullish candle, this is a proper Marubozu candle. We can see the open and the low is the exact same, and the close and the high is the exact same. This is a textbook Marubozu, and the fact that it has responded on the channel uh, really gave me really high confidence going into this, because this happened literally a month or two after my entry. And by this much time I had invested about 1.25 crore into the equity markets. And once I saw this candle, I decided to go, actually all in, actually, with the capital, like whatever capital I had. I decided to, really marginalize futures, not buy gold, and other things. Yeah, restrict bonds, no bonds, and just purely focus on equity investments, which is the first time in my 8 years of professional trading that I actually did this. Prior to this, I was not really big on investing in equities, but the current interest rate scenarios, the 25% increment in STT, the near, I don't know how many times the margins for commodities and other securities have changed. I just felt like it makes complete sense to allocate capital. It is just that I was surprised that I allocated 100% of my capital to this, leaving next to nothing for futures trading, or very negligible future trading, like 10-20,000 rupees stop losses, really, really small position sizes. Um, but yeah, and this obviously continued. And once the stock took out the 9500 high, there was no stopping it. And at this point in time, I was completely invested in the market. And even though the equity portfolio was doing really, really good, uh, I was I obviously I wanted to get back into trading futures. And so this was becoming a battle on when to book profits and how to book it, and how to structure trading going forward. So a lot of challenges were happening. Obviously, this point where the cursor is 1st February 23, pretty close to the time I prepared my last video on YouTube, because simply the intensity of participating in the markets in the last 6 to 10 months has been high, and it really peaked somewhere around March, April for me. And so I mean, this is around April. By this much time, this is April 23. I mean, right here, this candle is April 23. By this much time, I had pretty much committed quite a bit, 80%, and there is no ambiguity that by May 23, I was almost fully invested into the markets. And obviously, obviously, the this was my stop loss 7,500, and then once the market did this, I mean, it clearly took out this high. Now this stop loss of 7,500 is obviously moved to 8,500, and I am certain that now, I mean, the investments that were made around this time, I'll just try to highlight, March, April, February, March, April, because this was like really the intense periods. So these three candles that you're seeing, yeah, these three candles that you're seeing, I mean, if you just again, I mean, if since we have zoomed into this, you will again see a sort of a very small bullish flag again play out here, right here, and I'll just choose the trend line only because there is a problem with the parallel lines. Right here, so we are seeing this, and now, as per perfect theory, again, this is not a morning star, because this is not I mean, this is not a morning star, because the gap in this candle, red candle, that is March 23, is not there. But on the monthly time frames, this is as good as a morning star, and we are seeing 1, 2, 3, 4 marubuzos for 4 consecutive months. The small cap index rallied, 5th month, 6th month, and actually this is where we are currently. So needless to say, the decision to go long in equities would have paid off, and now the question is, what do we do next? So obviously, I'll just clear off these lines. We can obviously see that from 9,500 to 7,500, there is a 11,500 target, and this flag pattern target has also been met at 11,500, which is in the month of August. So there is no ambiguity that the period of you know August would be a point in time where you would want to start taking a little bit of profit, and a little bit of profit simply because you want to re-enter the market. There is no question of leaving such a bullish market. There is no question of I mean, if a market is creating repeated all-time highs and you're not participating in it, the question is like, when are you planning to do it? And now, once I see a structure that looks like this, after having, I mean, now I will ignore the zig, the minor, the inconsistent, that is the patterns that are being formed here. I'll ignore this, and I know this is the higher top, higher bottom. I can easily select, and I know that last time at a 38% Fibonacci retracement, the market took full support, and when there was a 38% Fibonacci retracement and I actually bought on the retest, I did quite well. So logically, I am going to follow the same approach, or that is going to be my default thought process, that this time the 38% Fibonacci retracement is here at say 10,700. So there is no ambiguity in my mind that any pullback all the way till 10,700 on a support and a break on a shorter time frames, I will be buying into stocks. There is absolutely no ambiguity in my mind, and I would be quite confident going right up to this level, which is the 50% Fibonacci. At the 61-62% Fibonacci, I am not feeling great now. Okay, I can tell you very confidently, on a monthly 60 odd percent Fibonacci, I'm actually getting ready to book. And at the monthly 78% Fibonacci, there is no ambiguity that I would have been completely stopped out of the system, and I wouldn't even be considering actually going long. And I would be open to both trades. I would be looking at it as a range with a long bias, as we discussed earlier. So this has been the plan, and the idea now for me is to just share with you how this plan played out in the last 10 months, because prior to these 10 months I was sharing very regularly the updates on futures. But this time around, for once, I want to share the updates on equity, and uh, and in the equity, I means obviously, instead of sharing what are the current gains now, there is this very active trend that is ongoing, of people not showing verified PNLs, or people selecting a particular time frame and deciding on a PNL, etc., etc., to make it look good. So it makes complete sense that if you are a SEBI research analyst, and if you are doing this professionally, then you show what you do basically. And any reasonable educated person understands that a person's trading career is essentially is essentially a culmination of years of research, and all of that research and all of that planning, um, all of that planning that goes wrong, and all of that learning has to happen on one account, which is going to be your account. And once you have done that, you could handle multiple accounts of your family members, multiple accounts of other people, and there is a certain sweet spot of capital at which you tend to do well, and that is something that you learn from experience. Regardless, I would like to share, or I would like to continue to share about experience, and I think it makes sense if we start off, instead of showing, like, obviously we have just seen how bullish the market is, and logically we would have seen, um, we know it that anyone who invested in equities will be profitable. But my idea now is to share right from 2017 April, uh, exactly, I mean, what is happening. And the first screen that I want to share is that in 2017 April, I had 5,35,000 rupees invested in Zerodha, and to the best of my knowledge, 2017, my average traded capital was at around 8 to 12 lakh rupees. So I'll just erase these few points and just share a bit of a background. And the reason why I'm sharing this backdrop is that just recently I had a 10-year alumni meet with my friends in my post graduation college, and some of them, most of them, said that the content that I produced encouraged them. So and and in that spirit of and in that spirit, I just want to share that this whole process of trading for me has been is much more than just money, and yeah, and it doesn't matter what is the starting capital, or I've just learned so many things. For the first 5 years, I think I learned how to navigate price action and charts, and subsequently after that I have been learning more about people as I manage more and more accounts, and how they perceive losses, and how important it is to make sure that when you're managing money at scale, you're not taking the kind of risks that you are used to taking in your own personal account, and to get it in a structure in which you are not taking as much risk but still retaining a possibility of growth. It has taken me 8 years for sure, and I wouldn't say it's very good, but in these 8 years, but in these 8 years, I've definitely learned a lot. So I wouldn't say that my level is really high, but it's much higher than what it was in 2015 when I actually started trading. So just as a backdrop, in 2015, when I started trading, I started off with a capital of rupees 1 lakh. And the reason was for starting at this capital is that because this amount is something that I considered high, but not high enough. I was comfortably drawing salary more than this amount on a monthly basis, and I had zero exposure. I didn't have a demat account or anything. I didn't know what was Nifty, Bank Nifty, options. I had absolutely no idea, and I was certainly not coming into the market for that. I was coming into the market to buy private banks, and when I opened my account with Angel Broking at the time, um, their dealer called me, and he said that, sir, should we do some options? And I was like, obviously, I don't know what they are. So I said, I'll read up on it, I'll study it, and then we'll do it. So let's assume he called on a Monday in 2000, in the month of May 2015. So I obviously postponed that decision. Uh, and by the end of the day, I had not studied anything about options, or I mean, I didn't even Google the term. Tuesday again, he called and said, should we do some option trading? And we have got this advisory call, etc., etc. And this is complete Greek and Latin to me. So I said, I'll study it, and regardless of whether I study it or not, we will definitely trade tomorrow. And so I started studying a little bit of options, and the content that I read was, difference between American option and European option, and that option is something that it gives the user a right and not a obligation, etc., etc., which was obviously of no relevance actually, towards trading. So when he called on Wednesday, and he said that, sir, it's been days that your 1 lakh rupees kept in the account, and you're not investing, you're not trading. I strongly suggest that you trade options. And I said, fair enough, let's do it. And that's it. And that's actually how I started trading options, by listening to an advisor that was assigned to me by Angel Broking in 2015. And what this advisor did is, on day one, like the day one, like on a Wednesday, he took the trade at say 12 p.m. or 11 a.m. And he calls me 10 minutes later and says that, sir, we made a profit of rupees 2,500. And this was in half an hour. And I was like, what do you mean? He's like, that we make profit of rupees 2,500, which mean, and I actually had to ask him, so which means that if I withdraw the money now, I can withdraw 1 lakh 2,500 instead of just 1 lakh. He's like, yes. And I was like, this is just insane. I mean, it's in a day, uh, in half an hour. He's like, yes, it's possible. I was obviously I was mind blown. Actually, my mind was blown. I had not even I never knew this was possible at the time. That in 15 minutes you could generate a move that gives you 2% on your. Obviously, this is not my net worth, but from the perspective of managing money, this seemed like quite a lot of value, and I felt great. So when he called me up on Thursday and said that we would trade these trades, logically I said yes. But this time he did not call me back in half an hour. He took the trade at 10 a.m. and he called me at 3 p.m. and he said that, sir, aaj loss ho gaya. And I asked him how much, and he said he lost 30,000. I was like, what? I mean, I absolutely had my mind blown. Now I was just completely, it was the first ever experience of losing money in almost anything, as far as I'm concerned. And to lose 30,000 like in a day, and for something that I have absolutely no understanding, like I have no understanding. And despite being highly qualified, I just could not believe it that I put myself into a position where I lost 30K. And I asked him, I was just so stunned actually that I just remember that the response to this loss was visceral. I could feel it inside, like various parts of my body, mostly the gut. I could have vomited actually. I means it was a tight slap on the face. And when he called me up again on Friday and said that should we trade again, I was just actually amazed that he had the guts to call me up again. And I was amazed with what I said after that. I said, okay, let's do it. And that day we had a small loss of around 12,500, or maybe 15,000. I don't know. Somewhere it was like less than 20,000. And just like that, on Monday I start the account with 1 lakh. And on by the time, by the time I'm uh, by, by the time I'm like trading, by the time the weekend has come, my account is at say 55,000. And I'm in a state of shock, and I'm so embarrassed that I can't tell. It's not about I can't tell. I just didn't even feel like telling um, anyone. So, but angel dealers are like really persistent. Like, they back then, this was all percentage brokerages. Zerodha was still not in vogue, and we used to pay a lot of money for all of that. And dealers had sales targets. He called me up again on Monday. And I distinctly remember the conversation with him. I asked him, when he called me up and said, I've got an advisory call, and they believe that the market is going to go in some direction and we should take up these strategies, straddle and all that. I asked him, just tell me one thing, how much are you paid in salary? And he said, I think something like 12,000 rupees. And it really, I had an idea that the person I was speaking to was not like highly qualified, but he sounded so technical. And I thought that there is always this set of people in the world who are highly technical and somehow not presentable to the extent that you would think that a person with that understanding would be. So I gave him the benefit of the doubt initially. And when he confirmed it that he's basically working the salary of a skilled labor, I truly felt embarrassed of myself that I'm actually taking money advice from him instead of doing something myself. But I was not sure if it was worth the effort. And so I just asked him the question that just tell me one thing. I don't know what you did actually. Like, I do not know. It's just showing me, the contract notes are showing me like hundreds of trades. I can't make sense of them at all. So I don't know what you did, but my question is that, assuming I did the opposite of what you did, like whatever you did, if I just do the opposite of what you did, do I make the exact same amount of money which I lost? And he said yes. So I said, that means there is a theoretical chance that after having lost say 45,000 rupees in a week, I on a capital of 1 lakh, I could actually make 45% or 50% on whatever capital is remaining on a weekly basis, doing what you did. He said yes. And I just asked him, what is it that you did to some extent? He said, we traded options, and that was it. I said, you hang up the phone now, I will trade myself. And that's how I started my journey in 2015. And after losing almost like 50,000 rupees in the first week of joining the markets. And then when I started trading myself by December, so this is all May 2015. By December 2015, my account is at like 8,500. So which means after the dealer at Angel lost 40% or 50% of my account, I ended up losing the remaining 90% of the account in the subsequent quarter. And I was extensively trading options. I was almost always, I felt I was right about the direction, but I could never make money. And this continued for about 3 to 4 months, till finally I decided that I'm not going to try and book out of an option. I'm just going to sit till the expiry, and I risk the premium anyways. So instead of trying to buy an option at 100 and then see it trade all the way to like 40 and then book out at 40 only to see it close at 450 at the expiry, I thought that I might as well as just hold it until zero, and I just have like 8-10,000, and I was extremely bearish on the market at that time. And I just bought, I think, 2 or 3 lots of at the money put options. That at the time it was say 7,900 or 8,000 nifty. I mean, I'm just speaking from memory. And by February 2016, my account was at 1,25,000 in just those trades. Like, I just took 3 or 4 trades and I recovered the entire money back. And I was quite exalted, or I was quite euphoric with my performance. And I pretty much closed the year at about 90,000. So I closed the year with a loss of about 10 odd percent, or maybe I might have even been in profit. I'm not sure, but it was so negligible that I didn't even think that I had to inform anyone about it. So I went through an entire year, a roller coaster year, where I did perhaps nothing but just study the process of decision making in the markets, to gain nothing. Maybe I just lost 10,000 on a lakh, or maybe I might have gained 5,000 on a lakh. But what I truly gained was a lot of experience, and an emotional roller coaster, because even though 1 lakh rupees does not constitute a significant portion of my net worth even back then, still it was money. And I could feel it. And I'm just so happy that I could experience such strong emotions with such low capital, which groomed me for many things further. By 2016, I had moved to Zerodha, because I was done with Angel and its dealers and their advisories. And Zerodha's low cost trading platform, low brokerage. I mean, it's not cost. The cost of trading is still high, but the brokerage, I was paying, I think, 75 rupees per lot on Angel, and Zerodha was asking 20. I didn't even think twice, and I moved into Zerodha. And with Zerodha, what happened is that I could access, somehow Angel website would not open in my office, but Zerodha website would. And for the first time, I could actually access intraday charts. And I moved the 90,000 rupees or 1 lakh rupee that was from the Angel account to the Zerodha account. And because I could see the intraday charts, it was opening in the office, I essentially became an intraday trader. And that 1 lakh rupee in 2016, that 2016, I saw, obviously, Brexit was the first major event, and which was loss making for me. But by demonetization, I had absolutely, I mean, it was just the best, in terms of absolute percentage gains. I think it was one of the best periods of my trading career. But the irony is that I was doing it all on 1 lakh rupee capital. And but that is an irony for everyone, actually. And then by 2017, I was trading with 5 lakh 35,000 rupees. I would be very happy to show you 2016 also, but Zerodha doesn't show it. So I had 5 lakh 35,000 rupees invested into the market. I had not added any money from my side, because that was never the plan. The plan was that I will put 1 lakh rupee in the market, and this 1 lakh rupee will grow, and and whenever I have surplus money, I will think about it. But I had never thought about trading, and I was actually trading, and I broke even almost the first year, and the second year, having 1 lakh moved to almost 5 lakh rupees, and the capturing of strong moves in during the process of demonetization and Donald Trump getting elected. It was a great time actually for me. I was truly enjoying the markets, and at this point in time, I was now thinking, I wish I could do this full time. And so yeah, but in 2017, I had 5 lakh rupee invested in gold in the markets. But the most important thing that I actually, so this is obviously showing my portfolio from that time. I'll just means I had zero mutual funds. I means I was not even investing in mutual funds. You can see that by ticking mutual funds, there is no change in this value. And you can see these loser stocks, but mostly, I mean, you will see that back then the value is not given here because of some issue from zero to end. You can see that this is 37 grams of gold, and you will see this sovereign gold bond, which has an expiry of August 2014. Because we know that 2024, because we know that these gold bonds were issued with 8-year maturity period. It means that in August 2016 and November, this is demonetization. November 2016, I would have bought these contracts because every time I was really profiting in the market, I was buying gold. And you can see that, even if I'm quite confident gold would have been trading at 27-2800 rupees at that time. But let's just assume that even if it were trading at 3000 rupees a gram, 37 grams is obviously comfortably over 1 lakh rupee. And I felt that, my starting capital is fully invested in gold. The surplus capital I'm trading, these are all for practice, but I was trading it in options. And in 2017, actually decided to start trading in futures. And that's how and that's how we are here today. So anyways, so this shows the status of the account in 2017. And I would just like to add that I never really added money significantly right until I broke my FD in January, February 2023. That is in February 23. So which means that after this 1 lakh rupee investment in 2015, my next investment was straight 1 crore in 2023. So which means it took me 8 years to gain enough confidence in my abilities that I can actually allocate 1 crore rupee of my personal wealth into the market on a single day. Uh, 1 crore rupee is good enough to lead the expenses of a standard household for, I think, maybe 5 to 10 years. 1 crore is good enough to comfortably buy a house in any part of Pune, or I mean, so many cities. I'm from Pune and Jammu, and it's very comfortably one can purchase this. So a decision to not go anywhere else and to leave the FD market and come into the equity market was a decision I could have never taken in 2015, or I could have never taken in 2017. In fact, I could have never taken it even a day before the day I actually took it, simply because maybe we are not ready mentally, or because we are not seeing the opportunity that we are seeing at the time. The markets were bullish for the greater part of this period, and I never felt the need to invest in the market. It is only it is only once the interest rates reached a sky level, and the futures premiums are so exorbitantly high, and the government decision of increasing margins at the start, from maybe increasing margins, like the margin required at the end of expiry could be almost 2 times the margin required at the start of expiry. Along with that, a 25% increase in STT I mean, I just feel this is all illegal. I mean, this is not fair. You cannot just change 25% of a key business component, a key business, a cost overhead, just like that, and and then leave out a crap disclaimer saying that 15 to 50% of all trading profits are given away in transactions. I mean, if you were so concerned, then why are you charging an STT when there is no physical delivery? I mean, uh, you pay these taxes if you're taking physical delivery of something. A futures trader is not taking physical delivery, and the STT is calculated on the contract value instead of the margin that is deployed. So we are deploying 1,25,000 rupees to take up one lot of Nifty. So if you want to charge STT, you should charge it on 1,25,000 rupees and not on the contract value of 10 lakh rupees that is coming up on Nifty. I believe that traders are grossly underrepresented in this front, and yeah. Any which ways, so there we were. This is sort of the backdrop, and we can see that in 2017 I had approximately 5 lakh in the market, and the starting capital of 1 lakh rupee in of 2015 was fully invested in gold, and I am extremely confident going forward. With this now, I want you to see the trading performance, in a more mature way, where a more mature way is got to do with the description that who is a professional trader. So a professional trader is a person whose dominant income source is trading profit. Okay, and a professional trader is also a trader who has been profitable over a 5 year period. Alright, I have already explained why over a 5 year period, why I have mentioned over a 5 year period, because I have already explained it on multiple forums, that in the first year, 90 to 95% traders will quit. By the fifth year, so this is in year one, by the fifth year, 98% would have quit. Alright, and in this fifth year, 1.6% will break even, that is on 2% CAGR, plus or minus, yeah, and only 0.4% will actually be profitable. Okay, and obviously, I mean, 98%, which means that for every 100 people who start trading with you today, 98 of them will no longer be trading 5 years from today. That's a fact, it's a guaranteed. And 1.6 of them will just break even. That is, they will have a change of 2% CAGR, and it is only 0.4% of them who will be truly profitable. And within this, it will be only 0.08% who will go on to become institutions. That is, they are connected to institutions in some way. They are either managing prop desks, or they are managing ultra high net worth individuals, either in private capacity, such as celebrities, politicians. They're just personally managing their demat accounts. It's like they have hired a trader for themselves and for their family money, or they're doing it in some capacity, like they would have got a desk, a terminal, and so on. And if they cross 10 years, 10 to 12 year period from there, then almost certainly they would be custodians of wealth in a formal structure, like a portfolio management service, or alternate investment fund. They would strongly look at creating something of that sort. They would have a strategy in which they could pool capital and deploy that strategy, because like I said, over a 10-year period, a trader is going to see all those pullbacks we discussed earlier, the Fibonacci 20% to harmonics, and trading 5-minute charts, 15-minute charts, 1 hour charts. If there is something that a trader would have learned, is to create a plan when he or she sees these patterns play out. So, so the fact that the fact that we have to be critical about is that 5 years is when we basically decide if a trader is ready to take the next step or not. So, for example, if you come here and I means there is a place where there is a chat. I'm not trying to say something to someone, but like say for example, if the person has obviously deleted the message, but okay, fine, but okay. The question is basically he deleted the message very conveniently, which is fine. But the question was basically, should I quit my job to become a trader? And my answer is at least just give it 5 years. You know, by fourth year you can truly start planning, and then by fifth year you are ready to do this. And even that is less, by the way. But at least you should give it 4 to 5 years before you even think of quitting a job. Regardless, we come to the reports column now, and we just go to P&L, and I will select the equity segment, and I will select the realized P&L segment, and I will select the dates from 2017 and April 1st. And my objective is not to go all the way till October 2023, because we discussed that the last year would obviously be profitable for me, but to view each of these segments in 5 years intervals. So obviously from FY 17 we need to go till FY 21, which would basically be March, which will be March 22, like that means the 31st March 22, because what I did in angel broking is not documented, and the 1 year that I worked in Zerodha in 2016 is not documented. So since the data available is for 2017, we will just look at it. We'll look at what we have basically. So 2017 till March 2022, 31st March 2022, we want to see basically what we have done across various segments, and I will select it, and sometimes it features in one go, sometimes I'll have to refresh it, so just be patient. So see here, error, so I'll just try again. I just have to be patient and sometimes a little lucky. Yeah, it has to happen when you're recording live. All right, we have it, fortunately. So we can see, sorry, this is the portion. So now this is not 1 year, this is not like 6 months or something. This is a 5 year period, and this is a 5 year period from 2017, at which point the starting capital of the account at that time was approximately 5,35,000, of which I mentioned that approximately 1 to 1.25 lakhs was clearly invested in gold, and continuously investments were made, which I will share later. So we were just really trading with 3 to 4 lakh rupees trading capital, and like I said, that no real capital was added right up till 2023. So you will see here 8.31 lakh, and what you will actually see here is just the sheer number of reds. Yeah, and I mean, you can count, there is just 1 2 3 4 5 6 7 8 9, there are just 9 green trades actually, and everything is a red. And we can see this, and the reason is this: when you put the cursor here, you will notice that on 5th April I booked a loss of 7,356, then on 12th April 2,600, then 19th April 7,000, 13th April 3,000 loss, 20th April loss of 2,400, and then my first gain happened on 20th April 2021, and that was for 2,307 rupees. I mean, it's not even comparable, the risk reward and the accuracy. So here, I mean, if you were just to look at the month of April, this is looking like they're given dates here of 2021. It is fine, it's how they want to place it, but you can just look that there are 3 to 5 7 8, there are 8 trade counts, only one profit, 7 losses. That's giving a system accuracy of 12.5% for the month. uh, it's just ridiculously low. But you will see the profit at 2 lakh, and the biggest loss, you can see the loss is capped at 7500. Like, you don't exceed 7500. So this is net loss, which includes all costs and everything. This is clearly, I mean, this is clearly about 20 plus times risk reward. You can see August loss 28,000. This, we are seeing bigger losses now. 3,485. Then we are seeing again here 6,700 loss, 9,000, 10,000, 6,000 loss, and then there is this green which has 1,79,000. So the very low accuracy, extremely low accuracy. But the few times that you get a trade, you should try to take a big one in, and this has been something that I have been consciously aware, and I try to do it, and I have been trying to do it for several years, not just in the equity market but on all markets. So anyways, 2017 to 2022, this 5 year period, we can see a net gain of 8 point at the starting capital of 5 lakhs. We can see net gains of 8.31 lakhs in the equity segment. In the FNO segments, this would be very active. I hope it works. We are seeing net gains of 31.81 lakhs. I mean, I will show you. I have already, all of these trades like that are there, like these 57 rows and all of them are downloaded on Excel. I will show it to you. So you see realized PNL of 37 lakhs, taxes and charges of 5 lakhs, and booked PNL of 32 lakhs. I mean, 31 lakh 80,000. FNO, Nifty FNO in currency segment, because I was, like I said, I practiced on every segment. There are gains. I mean, I did book a 1.5 lakh, but the charges were obscene. I was trying to day trade this segment. So I mean, in the end, I just basically broke even with 50,000 rupees over 5 years. I mean, it was not for me. I mean, I tried. You can see here, I tried all the currencies I would have tried for sure. Euro, I mean, British pound, Japanese yen, US dollar, all the currencies. Um, Regardless of their potential, regardless of the liquidity, simply because I wanted to learn as much as possible. And trading excited me so much. I was even trading international markets at the time. It was just, I was basically overdosing on it. And then there is this commodity segment. I booked 24.94 lakhs in this much period. One approximately 2 lakhs is this. So a 25 lakh gain, and 23 lakh is the net gain on commodity. It's interesting. Obviously, I means a lot happened in the commodity markets. We are talking. I mean, this date range is. This date range is clearly including COVID. Crude oil going negative, and prior to crude oil going negative, there was a phase where Yemen Houthi rebels sent rocket launchers to an oil refinery in Saudi Arabia, and news came out that 5% of the world's oil reserves have been depleted overnight, and consequently I got absolutely slapped. Because I was short on crude oil, and if crude oil reserves are getting depleted, it gave a triple upper circuit. But those experiences were critical and very important and very useful for me. And even actually, even I even traded mutual funds. I mean, I traded everything here to 3.3 lakhs. So across all segments, like be it equity, be it FNOM, so it's like say 8, I was 32, that's like roughly 40, it's 40.5 now. And commodity, it's another 23, so this is like 63, 64 lakhs. And then finally mutual funds, 67 lakhs. And like we discussed that my starting capital in 2015 was actually just 1 lakh. And by this much time, I was looking at career gains of 67 lakhs on one account. I was still during this entire time, I was not this entire time, but right up till 2019 April, I was employed also. So I was feeling quite good actually. You know, I had profited roughly 60 70 lakhs from the market, and I was employed, so there was huge cushion actually going into what I was doing next. Anyways, so this is the 5 years that we have. This is one cluster. Like, we have to see this as one cluster, and then we have to obviously see the next 5 years. So which means that I will select now the date from 1st April 2022. This is basically the just 2022. Okay, this is 23 October. So 1st April 22 to October 23. So now is the second phase. This second phase is basically your Ukraine Russia war, increments in the bond markets, the interest rates, the inflation, and but also a lot of positives, a lot of supply side inflation, but a lot of other positives from an Indian perspective. But I don't think so you can be that bullish if you were, say, outside of India. A lot of countries, say in Central Asia, like you could say Armenia, Azerbaijan, Turkey, they're going to have a go at it. Turkey and Greece, they are going to have a go at it. Saudi and Iran, the recent G20 development, Saudi will have US trying to give it complete protection. That's going to irritate Iran. Iran selling weapons to Russia. It's very very linked. We are seeing sort of aggressive geopolitics in which the major countries of the world are using small islands and small countries to assert dominance even more aggressively than what was the case in, say, the 60s or 70s, because that was typically just restricted to Africa. But what has happened in the 90s and 2000s is that it has actually spilled all over the world. So it is happening. I mean, that's the reason why people were so shocked that something like that can happen in Europe when it happened in Ukraine, because what is known as the Russia-Ukraine war is actually no Russia-Ukraine war. It is a Russia-NATO war, which happens to have happened at Ukraine. I mean, that's just that. So we are seeing a Russia-NATO war. This is a significant escalation from Cold War, like a significant escalation with absolutely huge ramifications and serious structural changes. So if you are going at a war with Russia, and if Canada is experiencing record inflations, you should not be surprised. These countries don't like each other that much, and they are very linked. Anyways, we will that's I digressed. So now we're looking at the ideally the next 5 years will obviously be from April till till FY22 to 26, but we are now at 23. So I'll just see what data comes out. Okay, the report is empty, so which means no mutual funds were traded. Commodities. Okay, it's showing something. So now in the last 1.5 years, my gains in commodities have been only rupees 13,000. Okay, so which literally means no commodity trading, right? So commodity trading has stopped. In the currency segment, gains are at 48,000, which once again means like no currency trading also. So even currency trading prima facie has stopped. So these are just 65,000 rupees in gains. And now FNO, you'll combine everything, because I'm not trading these securities, but now in future options, because we are dealing with the current time frame, so instead of only choosing realized, I'm going to choose combined. And yeah, this is the bad one. This is 20 lakh loss actually, and an unrealized of 75,000 rupees is nothing, is not good. So this 20 lakh loss, it's really bad. It's really really bad. I means a lot of mistakes. Uh, a lot of mistakes in the sense that I was trading just too large quantity at the start. I just wanted to, I just wanted to make like 75 lakhs to 1 crore per year, and I do not know, I was so fixated on that value that you know I I means I just clearly didn't capture much, like, you just seeing, I mean, to get an idea of how much quantity I was trading. We are seeing a gain of 4.5 lakh rupees for a percentage change of just 3%, 4%, which means every percentage change on ITC I would change by 1 lakh rupee. Yeah. And if you see on the downside, you will see M&M, in which I lost 2 lakh 15,000 rupees at 1.3%. It's just obscene. I mean, it's basically for every percentage change. I mean, I'm almost losing 2 lakh rupee on Mahindra Auto M&M. So this is just too much quantity. This is just too much quantity. You can see the buy value here is of 1 crore 64 lakh 67,000. It's just, it's just too much. I want 1 crore, I want 5 crore kind of an attitude in the market. And when you're trading these quantities, this 20 lakhs obviously looks like 20 lakhs is a huge setback. Uh, but I think you deserve it. I mean, if you're gonna be so stupid about it, um, see this ITC 1 crore 20 lakhs, Bajaj Finance 50 lakhs. I mean, I don't know if there was a way to sort it out from buy value, sell value, it would be quite interesting. I mean, if I take an average of this and what I was doing, just look at the taxes, 2.6 lakhs. It's just huge expense, yeah. So, so this is a setback. This is a setback, and we'll see how we will tackle it in the coming few months. And obviously now the equity segment, because this is a segment that has done well. What is this? Okay, so here we are seeing 43 points. No, sorry, 41.5 lakhs is uh, booked profit in the equity segment, and 25 lakhs is unbooked, which would mean that roughly 66 lakhs is unbooked in this particular segment. Though I am quite surprised. Okay, 1 second. Okay, fine. So it's just 42 lakhs. I was expecting it to be more. To be very frank, I was thinking this should be like well above 50 or something. But fair enough. I mean, fair enough. It is what it is. And it is also maybe the fact that Zero is currently going through some sort of a maintenance, because in my opinion, like, I think this should be 50 and the unrealized should be closer to 35. If I just go to the holdings, yeah, so this is the unrealized 36 lakhs 65,000, which is showing in the holding statement, but it is not showing in the console statement, which is okay. I mean, the holding statement is showing the bonds, but this is not showing bonds. I do not know how that works, but regardless, like, what I have done is basically I have prepared all of this in an Excel. So which means that my overall trading career is pretty much here, arranged alphabetically. And in this this is basically, and in this you will sort of see a gross PNL of 1 crore, and these are expenses segment wise. How much it actually cost me completely in each of these segments. So 1 lakh rupee, 5 lakh rupee, 1 lakh rupee, 2 lakh rupee. These are all the expenses that I have paid in terms of brokerage and taxes. So this amount is roughly 10 lakh rupees. So I paid roughly 10 lakh rupees in brokerage and taxes. I have paid taxes separately. This is 10 lakh rupees which is got deducted. Um, this is the difference between gross and net. So obviously net is, you will see here, gross minus these expenses. Now the term that I'm mentioning here is R value. I'll just highlight this so that we are all seeing it. I'll make it maybe white. This R value is basically the average. We will take the average only if all the trades in the column B from the second row right up till 2254 is less than or equal to 0. So which means if a trade is less than or equal to 0, we'll consider it a loss. And if it is a loss, we want to determine what is our average loss. Once again, this is our average loss. This is not the maximum loss. This is certainly not the minimum loss. This is just the average of all of our losses on a per trade basis. That is everything, right from 2017, which includes your R&D, your experiments, um, your lucky breaks. You got lucky, you were unlucky. Sometimes the broker platforms failed. Sometimes the terminals were shut down. Um, all of these things, gaps, slippages, like everything included, this is what you're losing on a per trade basis. Like when you lose 25,409. This is what this data is showing me. Over 2,253 contracts with an accuracy of 40%. So which means not only am I losing, I'm losing more than half my trades actually, as per this data, which is true. And I am gaining 48,000 rupees on an average per trade, which is a risk reward of just 1.9. Like it is coming close to 2 because, um, because this data also includes bonds. And what happens with the bonds is that it artificially jacks up the accuracy, but it seriously lowers the profit. And otherwise the profit ratio is closer to 2.1. Expectancy is obviously how much you expect every time you trade. What do you expect? And you expect to make 4,600 rupees. And this is obviously because this data is from 2017, which had just 5 lakh rupees total capital, and 1 lakh was in gold. And the serious inclusion or addition of capital actually happened in 2023, where I decided to use the money, or I had the confidence to use them, or I felt I have the confidence to use the money to go long equities and to go long bonds. And of course, I intend on completely trading FNO, despite that loss that we are seeing. I mean, down but not out, let's just say. Median of minus 2825. So what does median basically mean? Median means that this is what you experience on general. So expectancy is the average. This is what you get in general. So in general, every time I trade, I make rupees 4,605, factoring all expenses. And in general, what I feel I make is, I feel that I'm losing 2,800 rupees every time I take a trade. Now you would ask, how can a person who's actually making money feel like they're losing money? And the reason is because you have extremely low accuracy. So when you are having extremely low accuracy, like we saw in the first 5-year graph, where in a month I've made 8 trades, lost 7 of them. Greatest loss is say 10, 15, 20,000, and the greatest winner is 2 lakh rupees. So it's about risk reward and accuracy. We have to see them both in play, and traders have to decide whether they want to have a small risk and a multiple of that as reward, and then trade very often, versus having a large risk, a multiple of that reward, and then trading fewer times but trading many contracts simultaneously. There are many combinations, of course, but what this is saying is that the experience is negative, though what the result is positive. A standard deviation of 74,852 is obviously obscene, but it will change, because if say this data were in US dollars, if this were converted into US dollars, then this number would also be converted into US dollars, and therefore standard deviation, though it is telling us how much are you moving away from the mean, is not the is an essential prerequisite. But what we really want to do is we want to determine the coefficient of variation, which means that if on an average you are making 4,000 rupees, but you're deviating by 74,000 rupees, uh, you know, what is your coefficient? I mean, it's like, what is the variance? And the answer is obviously going to be standard deviation divided by the average. And which means that if the numerator, that is the standard deviation, is high, then this account is showing a lot of volatility. And similarly, if the average, the expectancy is high but the standard deviation is small, then this account is very, very stable. That is, let's say for example, let us assume that a trader is making same 4500 rupees, and this trader is also got a standard deviation of, let's just say, 9000 rupees, which means that this particular trader on an average makes 4500 rupees, but does not tend to exceed 13500 rupees in gains. This is general, like, this is like we would say one standard deviation, two standard deviation, three standard deviation, etc. So here what we are seeing is that if 4500 is, say, one stand is the mean, and let's just say now we are saying 75000 is one standard deviation, then obviously three standard deviation is 2 lakh 25,000, which means in order to get this 4500 rupees, you can be reasonably sure that a certain percentage of my trades cross 2 lakh 25,000 rupees, because we obviously have more than 30 data entries for it to be, say, statistically relevant. And we are seeing, I mean, if I were to draw a cumulative graph like a bar chart, you would see it, but obviously we'll not do it right now. So this ratio of standard deviation and expectancy is what we will call coefficient of variation. And in general, higher the coefficient of variation, the more worse the system is. Okay, I'll repeat. Higher the coefficient of variation, the more negative is the experience of the system from the perspective of the trader. And the reason is because systems which have very high CV means that the trader will sleep very little. I can assure you, the traders, the investors in the ecosystem will be very uncomfortable. Even though in the end you are to make money, the process of making money is not smooth, and either the trader continues to enjoy the thrill and take up positions like that, or the trader, knowing that this kind of a standard deviation is there, take on measures to control it. Yeah. And how do you control it? You don't want to control a positive standard deviation on the upside. What you really want to do is you want to make sure that you're not getting slapped on the downside. So for example, we will see that my average loss is 25,000. The average loss is 25,409. And if I were to select all the data points here, now if you look here, we will see the sum of 1 crore 3,74,000, which is looking great. This is our average 4,605. And now just see this maximum loss, like this is the minimum value in the system, and this is a negative 7,81,000. So which means that even though my average loss is 25,000 on the account value as has changed since 2017, even though my average loss is 25,000 rupees, when it comes to taking a slap in the market, I am willing to go till as much as 7.8 lakh rupees. This is the definition of a very high standard deviation, and a deviation going on the negative side. And obviously the only reason why we are surviving is because our maximum gain is of 12,12,000 rupees. Yeah. And after having gained 12 lakh rupees on a single stock in a single trade, because this is what the each row, like for example, this is Adani Ports 2017 December, Adani Ports 2017 November, Adani Ports 2020 July, then these options. So each contract represents a full trade. So the point being that in this criteria, we will see that when it comes to making money, I could make 12 lakh rupees in a single trade, and I could lose 7 lakh rupees in 8 lakh rupees almost in a single trade. And bottom line is, I'm risking 25,000 rupees. So the question is, what can I do in order to continue risking 25,000 rupees, but to reduce this coefficient of variation in a manner that I do not lose out on any of these gain possibilities, but the journey is smoother. And this is basically this has basically led into a lot of systematic changes, and a lot of decision making changes and watch list level changes. Anyways, coming back, then we have skewness. Skewness, you always want a system which skews on the right side. If you have a system which is queuing on the left side, then you should not add serious money. You should not trade very often on such a system. A system which skews on the left side, a common example of such a system is option writing. The reason why option writing will skew on the left side is because their greatest loss will always be greater than their greatest gainer in absolute terms. And obviously, if the left side of the graph is undefined, whereas the right side of the graph cannot exceed a certain level, the skewness will shift to the left of the graph because the graph is so much bigger on the left hand side as compared to the right hand side. And now, factoring, all of these, I generate a system score which is 31, which is actually very good score, but not very good because this is over 7 years of data, 6 to 7 years. So, in that context, it is not very good. In that context, one could argue that I have not learned things as quickly as I should have. But in my defense, you are seeing, or what I am showing is just one account. I can assure you there are comfortably more than 100 accounts, and the each account is of a different size. Each account, quite a few of them are family. My dad, my family, immediate family, but significant chunk more. I mean, I would think that from the 100, at least 95 will be from people who are not blood related, and individuals ranging from the age of 22 to almost 85. Uh, Enormous experience, and enormous experience at a time when I have booked a loss on FNO but a gain in equity. So, which means there are certain pockets which are doing well and certain pockets which are not doing well. But so managing all of that, along with these decisions of how much to invest, when to invest, etc., etc. So I wouldn't call it that I'm a slow learner. It is just that there is so much to learn, and it is so important to learn these things um, correctly, at least to the best of your ability, each time you make an attempt at learning, that it naturally slows you down a little bit. I think naturally, from my perspective or from my areas of strength and weakness, but maybe not so much for someone else. So a 31 system score is good. The question is, how are we arriving at this value? So a successful system is a system in which um, our realized PNL is really good. Like our whatever I means we can just yeah. So our realized PNL of total contract value. Not understanding why this is here. Okay. Anyways, the function here is that the total PNL that I have realized, more PNL the better. The total system accuracy, this 48% accuracy that we are seeing, the better. The higher the accuracy, the better. The higher the risk reward, the better. Like uh, the higher the risk reward, the better. The greater the skewness, because so see, we are basically saying that a system which can trade 2250 contracts profitably is much superior than a system which can trade just 5 contracts profitably. So the fact that there are 2250 contracts that we are assessing this data on makes this data more reliable. And if suppose instead this data were to say, we were to conclude that the system has a 41% accuracy based on 25,000 trades, you can be more sure, more certain that yes, the system accuracy is 40%. Since this has come in 2253 trades, uh, you will obviously be reasonably sure that yes, the system is at 40%. But system you will note that the trader capabilities, security selection, time frame selection, etc., 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 is changing, and will keep changing, at least for the first 10 years in a trader's career, till they acquire satisfactory amount of capital, where allocating capital is the greater challenge. Allocating capital meaningfully, because there are so many other constraints. I'll talk about that some other time. But a system, so which means if I were to receive this data on only two contracts, this number would be multiplied by 2, which is much lesser than 2000. And more the number of contracts that a trader is trading, uh, the better it is for the trader, assuming the trader is trading profitably, and that is determined if the product of your accuracy, which is 41%, 40.88%, and your GRR, which means your gain to risk ratio, is greater than 1. And your skewness, I means the more positive the skewness. So a skewness of zero point 0.3 is insignificant statistically speaking, but we must understand that because this portfolio is also consisting of bonds, um, and also consisting of a lot of poor trades, that this number is below zero point 0.5. But one of the key goals of a trader, at least a directional trader, should be to have a skewness above zero point 0.5. um, if I were to take off the phase in which I have booked like some 40-50 lakhs in booked profits in equity, or 25 lakhs 35 lakhs unbooked profit in equity, Zerodha console and Zerodha holdings are showing differences in value, and I'm quite sure it is showing a difference of value. um, I means because I actually posted on Twitter just yesterday or day before yesterday a verified PNL of 51 lakhs. So I know it is showing a difference of value in the equity segment at this time, and maybe it is also because it's late in the night and the systems are getting updated. But I've obviously, these are all the trades, but these are not the unrealized gains. These are all booked trades. The result is out there, and these are not unrealized gains. So even the unrealized gains, we can always discuss it 6 months later what happens to them. So in general, more greater the number of contracts, the more accurate the system, the better the risk reward ratio, the greater the skewness and lower the coefficient of variance, the better the system. And this is actually what is factored into this. And the utility of this is that I can select, for example, I can just choose to say, for example, I only want to look at my performance on say these 15 stocks or only 100 stocks, or I want to select from a particular date range. I can do that, and I can determine. So let's say, for example, I have a system which currently I'm trading the monthly charts and monthly, weekly, daily charts. So obviously these systems are generating certain results, and I know the periods in which I'm trading these systems, and I have data for when I was trading the hourly charts, and I know the periods from which I was trading those systems. I can compare the system by system with a single number, and that number is basically the system score. And not just a system to system, the greater utility is that, let's say for example, I wish to hire more traders into the system, in my company, because we have clients ranging from 50,000 rupees to 5 crore, and I want to focus on I want to focus on a particular segment, and there is always another segment that is available. And yeah, and so but you want a trader who actually has a positive system score, even before they have come even before they have come working in the company, because otherwise you will be teaching them absolute basics which they should have learned on their own if they were reasonably motivated enough. Anyways, it's been an extended video. I hope the video taught you about how to assess trend, how to determine which pullback to buy, how we look at tactical confirmations on candlesticks, how we assess the broader market before we actually go towards individual or select stock selection, how we lay out a broader plan that when we are entering at say 9,000, we will exit at 7,500, and why, and what will be our target plan based on a certain pattern that plays out in the previous up move. And and how changes in interest rates, changes in STT, changes in margin requirements can impact even traders with years of experience, traders with years of being profitable experience, and how it is critical that one maintains a learner's attitude and sees everything as a feedback and takes the necessary steps towards a subsequent improvement. And I hope that this extremely lengthy video has not been boring for you and is a reasonable step in your direction of improvement. With that, I will I will close this video, and just wanted to add that I have recently published a book. It's called Trading the Correct Way. It deals on another topic. It deals on the concept of money management, and it is available on various sites like Flipkart, Amazon. But the publisher site is Bluerose Publications. You can check it. It's uh, the name is Bluerose is not very popular, obviously because I'm not a very good writer. But I mean, in case you were curious on the maths behind money management, I feel that I have covered certain concepts to the best of my ability, and I would just encourage the reader कि लफ्ज़ों को नहीं जज्बातों को समझो kind of an attitude. Like, don't go on the means I've tried my best to have it of the highest quality, but just be forgiving, because the reason why I published that book is because for the greatest time I was thinking of how much am I going to invest in the market, how much is going to be my average risk per trade, under what circumstances will I drop a system, under what circumstances will I add capital to a particular system, because at this time I was trading hourly, daily, weekly options. I mean, everything, currency, commodity, all of it was just going on. And I was approaching a point in time in my trading career where I had to specialize and choose where I actually want to really, really go. I mean, do I want to excel in commodities? Do I want to do it in currencies? Do I want to do it in futures or equities? And if so, in which time frame? Or do I want to, excel in equities in the mid to long time frame and then come back to futures and work on shorter time frames? So these are a lot of decisions which are a function of not just money, and these are also a function of your time and your willingness to commit yourself to the market. So many variables. In that context, I hope that what I have said in this video, what is eventually written in this book, Trading the Correct Way, and the social media engagements that we have on LinkedIn, Twitter, and YouTube, hopefully starting today, will be meaningful and useful for you going forward. Once again, I hope you have a good weekend and a good market holiday, and we will speak soon. Take care.